Associated corporations are basically companies that are under common control. And what that means is they have to share various expenditure limits. In Section E, we talked about the phase out of the enhanced credits based on expenditures going over a certain level. So as the taxable incomes of the companies go over $500,000, between $500,000 and $800,000, we lose the $3 million expenditure limit. Likewise, as the assets of the company, the taxable capital, go over $10 million, between $10 to $50 million, we again phase out that $3 million limit. So either of those two events, amongst all companies under common control, can create such a problem. One of the good examples that we've seen on control includes not only actual voting control, what they call de jure or voting control, i.e. I own more than 50% of the votes of the company, so I clearly control the company unequivocally. There's good cases where individuals may have less than 50% of the total votes, but still be deemed in control. Such a case was Mimitex Pharmaceuticals. In this case, we had a Canadian company, or so-called Canadian company, Canadian-controlled private corporation, which was owned 25% each by 2 Canadian directors and 50% by 1 US director in California. So at 50-50 is actually still meeting the definition of Canadian-controlled private corporation, which is a Canadian corporation not controlled by any combination of foreign parties or public companies. So 50-50 is still no control. That could have qualified as a CCPC, or Canadian-controlled private corporation. Sadly for the company in this case, it became privy to the CRA reviewer during the review process that the foreign director during the year had undertaken certain transactions, such as firing the head of SR&ED and replacing him with someone else, along with other transactions. And unfortunately for the company, this director had done those tasks without asking the concurrence of one of the other 2 directors. He didn't say, hey, I recommend we fire the head of R&D and replace him or her with someone else. He just did it. And the courts and CRA thought that as enough evidence to show that clearly he was in factual control, even though he didn't have clear voting control of the company, and therefore the company was not a Canadian-controlled private corporation. In this case, sadly, their refundable credits became non-refundable, and the company lost over $200,000 in cash refunds. So again, understanding the issues of associated corporations, what does common control mean, and how do we differentiate and optimize that definition is critical to optimizing the overall SR&ED claim process. A quick overview of the types of relationships inherent that can create tax issues is often misunderstood by accountants. So I'll do a quick overview here. The first is what we call associated corporations, and that's what we're looking at for SR&ED tax credit purposes. That means basically that the corporations are controlled by the same person or group of related persons. The effects are that we have to share expenditure limits, not only for SR&ED, but for income taxes in general, something called the small business limit, where a small company on active income pays a lower rate of tax on its first $500,000, and as it goes over this, its tax rate generally doubles. Okay? The next definition is what we call related corporations. Related corporations have no immediate tax consequences other than any transactions between them are deemed to be happening at fair market value. So if my brother and I each have our own corporations, but none of us own shares of the other, we're not associated corporations. There's no cross ownership. He controls his, I control mine. However, we are related corporations because my brother and I are related under Section 251 of the Act by blood marriage or adoption. Our companies are related. If we do transactions together, we're deemed to do it at fair market value, which basically means we want to try to do things at fair market value and not give each other deals that wouldn't be available to the general public. If we were to do such a thing, the Income Tax Act steps in and deems the transaction to be done at fair market value, which is generally an unfavorable thing for the taxpayer. In my example here, if my brother was to sell me an item that would normally cost $100 and he sold it to me for $80, for example, he would be deemed to have sold it for $100 and pay taxes if he sold it for $100, even though he only received the $80 from me. And on the flip side, if it was a deductible expense, it was a business asset for me I was going to use, even though my brother paid tax on the $100 in his company, I would only be able to deduct the $80 that I use. So again, it's in a claimant's interest to make sure that all non-arm's length or related party transactions are done at fair market value. The very last definition that people get confused with is what's called connected corporations. This is important to some other advanced tax planning areas or transfer of non-arm's length expenses. A connected corporation is basically any corporation where another corporation owns 10% or more of the votes in value. So if we have 10% or more of the votes, more than 10% of the votes of value, effectively what happens is we can take the after-tax profits of one company and pay a dividend up tax-free. So often when we talk about later transferring credits from one company to another through shareholder elections and things like that, these become unnecessary between connected corporations because if a corporation's connected, I can dividend the money up tax-free from one corporation to another without having to file all these fancy elections.